Currency has been one tailwind for this clutch of companies, and that's the first one on my list today. HCL Tech. I'm starting with numbers after markets yesterday. I would say it's a mixed bag, but in the overview, I'm giving it a thumbs up because of largely the commentary as expected. So if I look at the key highlights, revenue and profits are slightly below estimates. Margins were in line. The fact that the FY25 revenue guidance has been upgraded is the reason for that thumbs up. It's accounting, of course, for inorganic growth as well for HCL Tech. The FY25 operating margin guidance has been maintained. The total contract value of new deal wins is down 5.5% Q on Q, but up 8.7% year on year. Let's come to the core numbers. Revenues for HCL Tech went up 3.6% to 29,890 crores, lower than estimates of 30,000 odd crores. The EBIT was up 8.6% to 5,821 crores, again slightly lower than estimates of 5,864. Margins have been at 19.5% versus 18.6%, bang on as far as estimates are concerned, and an uptick there. Net profits were up 8.4% to 4,591, slightly below what estimates were. Just a mixed bag of what brokerages are saying. They're saying a little good, a little bad there. Overall revenue growth has been seen. Management commentary is positive, in line with the outlook for the industry for 2025. And the deal pipeline is at a record high. Even though it is ticked down quarter on quarter, it is at a record high. The duration of deals is also decreasing. They're also pretty gung-ho on Gen AI driving demand in legacy tech modernization. So you might see a bit of an improvement in HCL Tech and maybe the rest of the IT space with it. But again, limited, because look at where bond yields are. So that is one which kind of balances out. Not too much relief for Angel One. Again, I would say if you look at this with a slightly closer look, yes, brokerage incomes have declined. It was expected because F&O regulations came into play, tightened it out, has squeezed volumes across the board. I mean, even for leading exchanges, volumes are down in the F&O segment, down about 30%. So obviously an Angel One would have been impacted. Having said that, total income is up 19%. Brokerage income has declined due to impact of F&O, but it's still a 5% beat to what Motilal Oswal's estimates were. Their operating income has been up 14% year on year at 414 crores, and OPEX was operating expenses were elevated, growing 23% year on year. Profits after tax up 8%, but the PAT was an 8% miss to MOSL estimates. So definitely you're going to see pressure in Angel One. You're going to see pressure in a whole host of capital market plays. Remember, they've also increased massively. Another interesting data point, and I'll just come to the third stock, but the STT collections by the government of India have been at record highs. They've surpassed all of their targets. So even if those volumes have come off, the fact is that trading quantity overall has not abated, and it's now a huge revenue garner for the government of India, as it always has been.
Yeah. Just a small nuance there, and which you are right, Tamanna. So I think there is a Jefferies note today which lays out that people are taking the larger sized, far dated contracts, and therefore exchanges are not getting impacted as badly, which is why I think Jefferies has upped the target on BSE. But for brokerages, and Angel One's F&O orders at 30.9 crore orders versus 34.9 crore quarter on quarter, and this was largely mid-November to December, right? Yeah. So not the full quarter impact, and you've already seen more than a 15% downtick in F&O order volumes, which shows that they will have to hike prices in order to maintain profitability, or go through a year of a base effect creation and then it kind of evens out. But otherwise, brokerages certainly have it tough, even if exchanges don't, and even if wealth managers don't, because they largely don't have a broking income. So it's not looking like a good number.
Charu on our reporting team did a story on how prop desks are actually shutting down across brokerages in the city because business is coming down. So from every angle, yes, that is a pain point to watch out for. But I just want to quickly round off my third stock, which is Bharat Electronic, and if we can just pull that up, BEL. Has seen defense order wins. It's got work orders actually worth 561 crore rupees, and which is why that is a bit of thumbs up for it. Accumulated orders are now totaling 10,362 crore rupees. And those major orders are in the space of communication equipment, electro-optics, upgrades for SATCOM networks, radar and fire control system, and spares. So BEL, I would say a bit of an underperformer after its nifty entrance. Could see some excitement today if the market mood holds up. That big if, of course, is there.
So a very interesting set of stocks. They're likely to move. I'm guessing the ones that I've picked will also move, and I've picked them on the back of earnings. The first one is one to watch. It's in the wealth space, and it's Anand Rathi Wealth. The earnings have come in with income up 30%. Some might argue that it's not as rapid a growth as they've achieved in the past, but it's still quite significant, one would argue. PAT has grown as much as 33%, and the AUM is up as much as 39%. Now, one other reason the stock could react, of course, is the bonus issue, which is 1:1 that was announced yesterday. And again, this is something that perhaps was expected, but rewarding shareholders. And they have been generating PAT at a faster clip than was anticipated, than they had guided. In the last financial year, they've had to up their outlook for PAT a couple of times. Let's see what happens in the rest of this year as well. Himadri Specialty is the second one. Again, this is a good set of numbers from the company, and this is net profit growth of 30% on the back of a margin expansion. Margins coming in at 19.4% in the quarter gone by, compared with 16.5%. And the new capex for high value specialty products planned at 120 crore rupees. That is something that has come through, and there is an expectation of ramping up certain segment production over the next 2 to 3 years. Certainly one to watch in trade today. And the last one is a thumbs down on the back of earnings. This is a company that has been under quite a bit of pressure on account of this pall of gloom, at least regulatorily. Den Networks, from the tax perspective, has been under pressure. The revenue is down about 4.5%, EBITDA losing about 32%, margin contraction very sharp at 11%. No, this is not actually no, we're talking about, all right. And you have a top line impacted by about, sorry, this is not the stock that I was talking about. Anyway, Neeraj, you go ahead.
Never mind. I'll pick up a bad name since there are a lot of results that have come out weak, and one of them is Delta Corp. So revenues were down 7.5% at 194 crores versus 210, and margins came off as well at 16.5% versus 26.6%. So Delta Corp numbers left a bit to be desired, and I would reckon that it might show a little bit on the stock. Remember, it's been a stock that has been beaten down, out of shape ever since the gaming issue started off, if you will. But yeah, the numbers left a bit to be desired. It's a thumbs down from my end, because the stock very likely should correct today. So watch out for Delta Corp. The other one is Marathon Next Gen. Revenues were down 41% at 123 versus 210. Margins at 29.5 versus 36.25. PAT down as well. Now, suffice to say, in a lot of real estate companies, the quarterly revenues may not make as much sense as the pre-sales, but watch out for this one. And very quickly, Bartronics, OFS by the promoter at 20 rupees per share. Very likely that the stock will see a small reaction for sure. So watch out for this one as well.